As far as I know, TRAC is the only 100% AI data-driven VC. As we like to say, data is our investment committee.
Hi everyone, this is Alistair, and thanks for tuning in to the Venture Variety Show. Today's guest is Fred Campbell. Fred is managing partner and co-founder of the venture firm TRAC. TRAC is an AI-driven venture firm. It uses AI technology to make its investment decisions. Last week I wrote a story about how TRAC operates, and the story was a broader look at the trend of venture firms using AI to make investment decisions, to conduct due diligence, and to support their portfolio companies. So in today's episode, Fred dives into the TRAC approach and how they use AI to make investment decisions, and the implications of what it means for entrepreneurs. Fred also has some advice for entrepreneurs. And Fred was an entrepreneur himself. For years, he founded companies, worked in tech. And then he and his co-founder, Joe Aaron, launched TRAC and started making investments in 2020. And as such, Fred refers to himself as a reluctant VC. So let's jump in, hear why that's the case, and let's meet Fred. Here he is.
I'm a reluctant VC. I didn't intend to become a VC. Last two companies, I focused on building technology that would help entrepreneurs better predict their outcomes, because I fell on my face for company number 6, and I came out of that thinking, well, that was pretty stupid. I built a product that nobody wanted. So I looked around for technology that helped me as a founder better predict market timing, product market fit, things like that are market based. And unbelievably, there was nothing out there. So I said, well, shoot, I'll do that. So my journey since 2013 to build technology that would help founders, but it actually also helps investors better predict if their investments will become profitable. So yeah, I tried to sell this technology, Alistair, and the VC said, well, if it's so damn good, why don't you invest with it? So I said, okay, I guess I will. So I became a VC. We've invested in 100 companies, plus or minus one or two, and about 60% of those are seed stage companies. So we actually can invest. We can be some of the first checks in a company, and we'll invest up to a level, let's call it a Series C, ABC, $200 million cap is our max cap.
And typically, are you looking to lead the rounds?
We don't like to lead a deal, but we will invest on our own. So if our technology says that a company meets all our criteria, I could literally call a company up and tell them, well, actually, when I was just recently at CES, I walked up to a company and I put them in our app that I have on my phone and met all our criteria, and I said that I could invest in your company today. Are you looking for some money? So we have invested without any other investors. We typically invest alongside other investors. Company doesn't, generally speaking, the company we talk to don't need our capital. We have to convince them to take our capital.
So you finished the anecdote. Did you invest in the company you met at CE?
Yeah, it's so the company is planning to raise a series in April-May timeframe, and the CEO was not on the floor of CES. I talked to their head of business development, and now I'm talking to the CEO. So I we'll see, but it looks like we will make that investment.
That's incredible. So going back to what you said, you look at yourself as a founder. You're using data. You're using analytics to invest in other companies. You consider yourself more as a tech person, as a tech founder, rather reluctant VC is what you said.
Yeah, no, reluctant VC. So yeah, it's for your your listeners, if they're mostly founders or tech folks, I'm building technology. TRAC is a technology company. I've raised 2 rounds of capital for TRAC. We're a team of about 10, mostly engineers, data scientists. I tried to actually sell my technology initially to VCs and other investors, and they like doing it their old-fashioned way. So, we've raised 2 funds and a number of unique investment vehicles. So about $80 million of venture capital fund money that we've invested. We've made about 100 investments, as I mentioned, about 120 in total because we made some follow-on investments in the same portfolio companies, but about 100 unique companies over the last, we've started investing in May of 2020. And so we've made 100 unique company investments, and I've yet to make an investment decision. So the technology, unlike any other VC on the planet, I don't make decisions. I build technology. The technology tells me if I can invest in a company or not. And the great thing about that from a founder's perspective is that as a founder, I've probably made 2,000 pitches, maybe 10 times that number. I don't know. It seems like I've been raising money half my life,
Right.
my professional life, and it's a waste of time for the most part. It's a necessary evil. You need the money. So with TRAC, I'm for better or worse, I've put your data in my algorithms and it pops out a score, like a FICO score. And if the number is above our threshold, I can invest. And if it's not, then I can't. So the good thing is I'll give you an answer in literally a couple of minutes. So it just saves the founder a lot of hassle. And then
Before we continue, you founded this company with a partner.
yeah, Joe Aaron, my longtime friend. Joe has invested in several of my companies, and I have assisted him. He's also a serial entrepreneur, but his has been mostly in the financial world. So he had a fund of funds in the hedge fund business that did quite well. And then he's had some other businesses, mostly in the financial world. And my last company, I needed analysis on investor quality. And he said, and there was no good data out there for that. And PitchBook and Crunchbase and CBS Insights, that sort of thing, didn't provide what we needed. So he said, I'll build a company that did that. And so he did, called DOS Analytics. And then we combined our efforts to create TRAC.
What made you think that creating TRAC, this idea of something entirely data-driven, an investment model, as you said, you're not like other VCs. You're not making investment decisions. You're not looking at your gut. You're not calling friends, working with people you've worked with before as the metric. You're using the data. What made you think that this was going to work?
A lot of my own experience as a founder. I mean, again, I've had companies. I'm the same guy, right? I've had companies a company that went public. I've had a company go bankrupt. So why? And honestly, the companies that have done really well, I just happened to be at the right place at the right time. And the companies that did not do well, I was too early in most cases. And talking to other founders and doing research, probably the number one reason for why founders fail is they round up capital. But what causes that to happen is because they not getting product market fit. Their timing of their product wasn't right. So yeah, I started looking at that as well. Can I actually predict? Can I get enough data to actually make predictions? And it turns out that we could. My last company, called CrowdSmart, doing something very similar to TRAC, slightly different technology. It was looking at, can you predict pre-seed? So somebody walks in with a business idea. Can you predict if that company will not only raise a seed round, but a Series A, their first institutional round? And the market's probably, depending on who you talk to, it's probably about 5% of the ideas or less get to all the way to a Series A. Well, CrowdSmart could predict that with an 85% accuracy, which was just unheard of. It was just crazy. And so it turned out that what we ended up looking at is the company in the right place at the right time? So that most VCs, especially seed, and again, I've raised seed for 5 of my 8 companies, is they look at the jockey, right? Do you invest in the jockey or the horse is the often expression, right? So they invest in the jockey because they figure that you're going to pivot 10 times before you finally have something anyway. So it's really the founder. And I would argue, no, actually, yeah, there's a few founders that will become successful in spite of everything. But most of the time, no, it's the market, the old expression, rising tide lifts all boats kind of thing. So if you're in the right place at the right time, your odds, your probability of becoming successful increases substantially. And then there's some other things you can look at. If you're in the right place at the right time, are you pulling in the right resources to become successful? Are you getting the really high quality team? Are you getting high quality investors who are very knowledgeable in the industry? Are you getting media attention or social media attention? These are actually things now you can measure. So if all of those things are in an area of science called collective intelligence. So if you can measure all the inputs relative to all the other similar inputs, like investors, right? We have about 300,000 investors in our database. But so if you get an investor who's very knowledgeable and has success in a particular area, and that area is similar to what you're building as a founder, and they want to invest in you, and you get a whole bunch of those, that is the collective intelligence of investors who are knowledgeable. That turned out to be also very predictive. I'll give you an example, right? I said that we made about 60 seed investments to date. Typically, after about 3 years, most seed investors, they've lost half of the investments. It's massive die-off because the company generally only raises enough for a couple of years. So if they don't raise money after 3 years, they're pretty dead. According to Carta, only if you started in 2022, only like 15% of companies have raised the following round. Not very good from seed, right? So the die-off is actually for 2023 and 2024 was some of the highest die-off years on record. And yet, in spite of all that bad timing, we've only lost 3 companies out of 60. So of our seed companies. So it's we can categorically say that using a data-driven approach can absolutely reduce what we call false positives, or what the market would call failures. We can reduce failure rate substantially, and that's just because the companies we're investing in are in the right place at the right time, and they can raise follow-on funding. We'll see over time if they're going to be successful, but we can certainly reduce at least the downside of what VCs typically have for our stage investing.
Sure. So you're looking at all these data points, hundreds of data points. You're looking at the investors. Do you ever get surprised? Like, oh yeah, I never would have thought to invest in this category, this company. Yeah.
It's usually the other way around. I'm convinced that we can invest in that company when I see it. I read about it or something, and the data tells me no, I can't. And believe me, I've gone to bat several times with our data scientists saying, no, the data's got to be wrong, and he'll pull up the data and we'll look at the detail, and he's won every time, unfortunately. Typically a VC has an analyst that they've hired out of college and does the work. Our AI is looking at hundreds of companies that are graded. And so when you're looking at all this data, you can and you aggregate all of it, you can see, is this industry group aggregating is it growing, right? Is that industry group growing? Is it attracting the right resources? Is it getting media attention? Is it getting high quality customer attention? And when you look at in the aggregate like that, if you're not growing, your chance of winning is really small, right? Because you have to take market share away from other people, which is really hard to do, right? When a market is expanding and you can see clusters of companies and there's some white space between your company and a cluster of companies, they're doing something slightly different in a rapidly growing market. That's that gives you a lot of confidence that there is something there. If the companies that I was saying I was advocating for, turned out that this was the only company in the entire cluster that was attracting any kind of quality resources. So, it's not a good sign, because what you want to be is you want a lot of competition that's saying, hey, this is a really hot market. This is a vibrant market. There's a lot of customer activity. There's a lot of media activity. There's guys like you that are blogging about it. I mean, that's kind of what you want to see. And when you don't see it, the probability is really low that that's going to be a breakout winner. Again, I don't know how you could do that analysis without technology. And that's VCs unfortunately are not applying technology to what they're doing. They're still doing it the old-fashioned way, which is larger their gut.
Looking at what you do, looking at what some other firms are doing, how is AI, data analytics, machine learning, AI, the broader discussion on AI, how do you see that reshaping the venture community and startups in the coming years? Do you think we're going to see more of your approach?
Yeah, well, when I launched CrowdSmart in 2013, there was, one hand, you could count all the VCs that were doing something with data science, early stage VCs. It was Signifire, Correlation Ventures, it was us. I mean, there wasn't that many. And there's now a industry group called Data-Driven VCs and it's got some branches to it. And there's now, I think, they count 170-ish VCs that are data-driven. So clearly the trend is data-driven. I was asked to speak at a VC conference in New York last September, and I was on the panel, and it was about the future of VC. And interestingly, there was 6 VCs in this panel, 5 women and me. And so they represented part of the trend, which is a lot more women in VC. And then I represented the AI part of VC. And I would say, a few years ago, when I tried to sell technology to VCs, the bigger VCs, I mean, I didn't talk to some of the smaller ones, but they were sort of interested in hearing what I had to say, but they would escort me out of their office. And now I was surrounded at this conference by VCs asking, how they can do what we're doing, is our technology available to them, that sort of thing. So the interest is clearly growing, but it's probably, egos die hard, as I like to say, and it'll probably be a co-pilot AI environment. So what does your AI tell you? I would say that it's hard, even in those environments where they really the VCs are making a commitment to invest in data science. It's still supporting somebody's gut or not. And the gut generally was going to win. The data science generally does not win in these firms. As far as I know, TRAC is the only 100% AI data-driven VC. As we like to say, data is our investment committee. We do not make investment decisions. If the data says invest, we invest. We try to invest anyway. So, yeah, it's definitely the trend that's going. It will probably, for a while anyway, it'll probably be, data supporting VC partners. But just like Wall Street, there's still people who pick stocks on their gut, but they have a hard time competing with the BlackRocks of the world who are completely algorithmic, right? Or a Renaissance Capital in the hedge fund business.
What, do you have for today's entrepreneurs when, specifically, I guess what, general advice is good, but, how to position your company, how to leverage the data,
That's a great question. And keep in mind, still probably 99% of the sources of capital out there are going to make decisions the old-fashioned way, right? But even for them, you just assume they're starting to incorporate some kind of data analytics in their decision-making. So they're looking for trends. So when the founder thinks about, putting together their deck, and how they describe themselves on their website. So who they associate with, who they say they're part of this industry. One of the biggest mistakes founders make is they say, I don't have any competition. I'm so unique. I don't have any competition.
Right? I hear that a lot too on my side.
It's the biggest mistake a first-time founder will make. You don't want that. You want to be able to point to incredible success of companies that are doing something similar to you. And so you're basically saying, I don't have to prove that the customer, the market exists. I don't have to prove that. The market has already spoken. It wants this. I have a very unique product that is going to be positioned well to take over in this market, to win in this market, to become a unicorn in this market. So if you're pitching to TRAC, everything you've ever said about your company, however you described a prior website, you've updated it, whatever you posted on social media, anything that's ever been said about you, just assume that is available to us, because it largely is, right? Try to get media. The biggest thing you can do for yourself is turn the equation around. If, for example, a startup never has to call me. I look at my hit list, and if your computer tells me, go call. So I'm basically just selling my money. I'm just calling people up saying, hey, can I invest in your company? But with the company I took public, my business partner was really good at getting media. And he got us in the front page, the business section front page of the Chronicle back then, Examiner or whatever.
Which was like your deal back then.
Yeah. And I never had to call on a VC. They were all calling me.
Yeah.
So turn the equation around. Don't try to find the needle in a haystack. Let the needle find you. So spend as much time as you are building your company, building your media footprint, or have someone on your team doing that. So those things, but let's face it, you're gonna pitch to 90% of 95% or more will be gut people. So a story is everything. And I have to pitch TRAC. I mean, people who invest in me are not data scientists. So I'm going to be raising a $10 million round later this year, and I got to tell a story. And so the shorter you can tell a story, I'm not doing it here, by the way, very well, but the shorter you can tell a story, the better off you are, and then back it up with data. So hit them in their heart first, and then support it with their brain. And that's usually a winning strategy.
From the media point of view, when I hear a company, over the years that I've covered business, if I heard a company say they have no competition, that's a red flag.
Bad.
It's wonderful to hear.
Yeah, don't do that. And by the way, here's something for you, Alistair, is that so our technology will grade different metrics. So who do you think has a higher predictive accuracy? Typical VC or a typical reporter or media person like yourself?
Predictor of accuracy. Oh, hey, I got to stick with my own. Let's say the reporter.
You are. Media in general.
Yeah.
Media is more predictive than VCs. So if you aggregated the stories you did and you essentially invested in every one of them, you would do better than most portfolios for most VCs.
That's funny because I do like to point out that I was on a pitch committee. I was on a pitch committee, a pitch contest, and the winner was TalkDesk. Now, I have to give credit to the VCs on the panel who guided the ultimate decision. But yeah, I do like to take credit for that I saw TalkDesk way back when they were a seed stage foreign-based company. So now they're a unicorn. So I'll take that. I'll take that, Fred. I'll take that. That wonderful gift. Thank you.
You're welcome.
Yeah, wonderful conversation. I could talk hours.
Appreciate it.
I'll give you the final word. Any closing thoughts for the audience?
Well, as a founder, there is some good news. The market is starting to open up again. It was a really hard time to raise money the last, couple of years. So money is starting to come back again. Valuations are starting to go up again for founders. Yeah, so it's a good time to be a founder. It's a renaissance time. But now you've got the money to actually go ahead and execute on your business ideas. So go founders. And of course, give us a shot too.
If people are interested in reaching out, what's the best way to get a hold of folks at TRAC?
You can go to a website and fill out a
TRAC.vc.
TRAC.vc and fill out a form that we ask you there. To invest, we ask 5 questions just to filter and make sure you don't waste your time. But on the website, if you, as a kind of a consolation prize, we'll give you access to our investor research tool, which is hugely valuable. So you're not wasting your time. Don't come to us until you've raised your first $1 million. There is exceptions, but generally speaking, you need to get some momentum for us to be able to invest in you. And we require 2 or more founders. We don't like solo founders. That's another little tidbit. So of the 1,000 or so unicorns that have ever come into existence, less than 5% are single founder. So your probability of winning in fact, you'll see that as a trend in VC right now. A lot of VCs are shying away from single founder companies. So just keep that in mind, founders. If you're kind of want to do it yourself, just know that you got the wind in your face, basically. And that's about it. If you've got all those, you can, and we'll give you back an answer usually within 24 hours.